Hello, my name is Mike Khalilpour, and I'm a partner at the Green Law Group here in Simi Valley, California, and head of the firm's estate planning practice. In today's webinar, we will examine the current landscape, including both income and estate and gift taxes, as well as briefly touch on actionable planning considerations to uncover potential opportunities you can discuss with your financial advisor, tax professional, or estate planning attorney. One thing to note is that today's webinar is general information and educational in nature. And for your specific matters, please be sure to speak with an experienced tax professional or estate planning attorney. You don't want to take anything I say today as the absolute gospel or the way to do things, since the law does tend to change on a regular basis. So what is true today may not be true tomorrow. There may also be exceptions or exemptions to the general rules that would apply to your particular situation. This is designed to be background information to help facilitate the conversation and probably multiple conversations that you want to start having. In December 2017, President Trump signed the Tax Cuts and Jobs Act, which was at the time the most comprehensive tax reform package since President Reagan's Tax Reform Act of 1986. The TCJA made broad changes to the tax code that impacts individuals, estates, trusts, corporations, and small businesses. While lawmakers initially thought to simplify the tax code, it did anything but. Some provisions have been eliminated or simplified, while new tax rules were added. The law fundamentally changed the overall landscape, and to complicate matters even worse, at least some of the provisions expire at the end of 2025. Currently, taxpayers benefit from favorable tax environment from both income taxes to estate and gift taxes. Considering the TCJA, which took effect in 2018, of course, marginal tax rates were lowered overall. However, with that, many popular deductions were either eliminated altogether or reduced. For example, taxpayers can no longer claim miscellaneous deductions, and the deduction for state and local taxes is limited to $10,000 a year. Combined with the fact that the standard deduction nearly doubled, roughly 90% taxpayers now claim the standard deduction on their return, and the number of taxpayers subject to the alternative minimum tax has decreased to around 200,000 taxpayers, as opposed to approximately 5 million prior to the change in the law. With respect to the estate and gift tax provisions, we're also in very favorable territory, since most will not be subject to that tax. The Tax Policy Center estimates that only 1,700 taxable estates will be subject to the tax each year, down from about 5,500 under the prior rules. Lastly, because of strict budget rules related to the passage of the law, most provisions, including these lower tax rates, are scheduled to expire after 2025. Now, here we're looking at tax figures for 2021. As a reminder, the top ordinary income tax under the old rules was 39.6%, which has been lowered to 37%. One area of significant change in the tax code is also deductions. With the standard deduction nearly doubled, most taxpayers will end up claiming the standard deduction, less so than itemizing deductions on their return. Before the tax law, roughly 1/3 of taxpayers itemized. Going forward, approximately 10% will be itemizing. Another key point of change in the tax rules was with respect to the home mortgage interest deduction. This has been capped at $750,000 in debt, down from $1 million before the tax code. For example, if you have a $900,000 mortgage, you can only write off the interest on the $750,000 of the debt, not the total amount. The debt can include the second mortgage, but the total debt cannot exceed $750,000. Additionally, state and local taxes, sometimes called the SALT deduction, taxpayers are now limited to a total deduction of $10,000, which is inclusive of not only property taxes, but also state income and local income taxes, as well as sales tax. So for example, if you have a $12,000, if you've paid $12,000 in property tax and $15,000 in state income tax, you can still only deduct a maximum of $10,000 on your return. Other deductions which were repealed as part of this tax reform package were casualty losses unless there is a federally declared disaster. And now alimony payments are no longer deductible to the person that is making the alimony payments. And on the other side, they're not included as income to the person receiving the alimony payments. Lastly, examples of miscellaneous deductions which have been eliminated include unreimbursed job expenses, certain membership dues, investment fees, and tax preparation expenses. The tax code, the TCJA also created a scenario where fewer estates are going to be subject to the estate tax. This is because the lifetime estate or gift exemption was doubled to over 11 million per individual. This means that a married couple can effectively shelter over $22 million in net worth from estate taxes. Of course, these rules do sunset after 2025, when the exemption amount will revert to its prior levels, adjusted for inflation. In addition to the tax code revisions, the Secure Act was also passed in December 2019. The Secure Act provided a broad range of provisions governing retirement plans, plan participants, and individual retirement savers. This legislation brings the most significant changes to the retirement industry in more than a decade. The new law is designed to expand access to retirement accounts, promote participation, and preserve savings. At the same time, it introduces new restrictions on deferring taxes for inherited retirement accounts. For example, most non-spousal beneficiaries are now required to fully distribute inherited account balances by the end of the 10th year following the account owner's death. There is no requirement for annual distributions. However, the account must be fully liquidated by the end of the 10th year. Prior to the Secure Act, the 10-year rule could be stretched out based on distributions and the remaining life expectancy of the individual or individuals that had inherited the account. However, that ability has been repealed as part of the Secure Act. While there are a few exceptions to this 10-year rule, mainly being that the inherited account owner is a spouse or beneficiary with disabled or chronic illness, or a child that's under the age of majority. So now, based on these two significant changes in the tax law, we're going to discuss some planning strategies that you might want to consider in saving for retirement, and generally for lowering your tax burden. First one thing that's considered is to donate IRA assets to a charity. This idea is to make donations directly out of your IRA through what's called a qualified charitable distribution. This provision allows retirees age 70 and a half and older to donate up to $100,000 tax-free from their IRA accounts each year. Generally, when you make a distribution from your IRA, it is treated as taxable income. However, under this provision, which was made permanent, does not get repealed after 2025, these assets are not only excluded from income if the distribution is made directly from your IRA to a charity. This distribution is not included to your income, so you avoid the potential negative consequences that a regular IRA withdrawal in retirement can create. The distributions are also excluded from income, are also equivalent to a 100% charitable deduction. Normally, charitable contribution deductions are limited to a lower percentage or eliminated altogether based on your adjusted gross income for taxpayers who do not itemize or take the standard deduction. It is important for clients to consider their tax situation before deciding whether to make this kind of charitable contribution from the IRA. Another thoughtful strategy that's been utilized is converting a traditional IRA to a Roth IRA. This can be an effective way to hedge against the threat of facing higher taxes in the future. Young investors or taxpayers in lower tax brackets may want to consider using Roth accounts to create a source of tax-free income in retirement. While it's virtually impossible to predict tax rates in the future, or have a good idea of what your personal tax circumstances will look years from now, Like all income from retirement accounts, Roth income is not subject to the new 3.8% surtax, and it is also not included in the calculation for the $200,000 income threshold. IRA owners considering a conversion to a Roth IRA should carefully evaluate that transaction, since the option to recharacterize or undo the conversion is no longer available as part of the Secure Act. The chart that's being shared right now, the chart compares tax brackets created under the TCJA with the previous brackets. Taxpayers benefiting from a lower marginal rate throughout the brackets, as you can see. The lower tax rates effectively lower the cost of converting traditional IRAs to a Roth IRA. In particular, some taxpayers may see this opportunity converting assets up to an income threshold of about $250,000. At that point, married couple is in a 24% marginal income tax bracket versus 33% income bracket under the old rules. Previous to the TCJA, many practitioners believed that it made more sense to execute a Roth IRA conversion earlier in the calendar year, which would provide a longer timeline for recharacterization. For example, a client converting in January 2017 would have until their tax filing deadline to decide whether or not to keep the conversion in place, effectively through October of 2018, which is roughly 20 months. Now that the recharacterization option has been repealed, this strategy is no longer available. Under the new rules, it might make sense to wait until later in the calendar year before converting. This provides a better chance for the taxpayer to understand what their taxable income looks like for that tax year, and conversely, how a Roth IRA conversion may impact their tax situation. Overall, more care and analysis now is needed before proceeding with the Roth IRA conversion, since there is no option to undo this transaction afterward. Given the uncertainty of taxes in the future, combined with the fact that most retirees hold a huge majority of their retirement assets in traditional retirement accounts, the need for some diversification exists for many. Utilizing this Roth strategy can provide tax-free income in retirement and help hedge the risk of higher taxes in the future. With the risk of tax rates edging higher in the future, some investors may consider filling up their tax bracket with additional income. Tax professional can help determine whether adding more income before year-end makes sense, or for those participating in employer plans or contributing to traditional IRAs, do Roth IRA contributions make sense? Lastly, there may be alternative ways for higher income taxpayers to fund, that is, to contribute to Roth IRAs. Taxpayers at higher income levels are prohibited from contributing directly to Roth IRAs. 2020, for example, income phase-outs begin at $124,000 for single filers and $196,000 for married couples filing a joint return. Taxpayers may want to consider funding a non-deductible, i.e. after tax, or what's called a traditional IRA, and then subsequently convert to a Roth IRA. There is no income restriction on Roth IRA conversions. However, adverse tax consequences, referred to as a pro rata rule, may apply if the individual owns other pre-tax IRAs. Before considering the strategy, taxpayers should consult with a tax professional. Also, participants in 401k plans may be able to make voluntary after-tax contributions into their plan in excess of their salary deferral limit. When allowed by the plan, these after-tax contributions may be directly transferred to a Roth IRA without any income tax consequences upon a plan triggering event. Now we'll take a look at estate planning considerations. The doubling of the lifetime exclusion changes the landscape for many in terms of planning for estates and gifts. If you live or have property in a state that would be subject to inheritance or estate taxes, you may want to consider options such as life insurance, which may provide liquidity at death to the survivors to pay that tax bill. Since full step-up and cost basis death is still available, many families still want to assess which property has low basis and try to maximize the step-up basis at death. For example, gifting assets while living will result in carryover basis to the person who received the gift. Additionally, certain trusts may be decanted or poured over into new trusts, which may account for the step-up in cost basis. For those in high-income states, such as California, creating trusts in other tax-friendly states may be a means of mitigating state taxes. For those who have funded trusts, the a bypass trust at the death of the first spouse, decanting these trusts may make sense to structure assets in a way where they will benefit from that step up in cost basis at death. This depends on whether there is the appropriate amount of estate tax exemption in place. Lastly, it's critical to work with a qualified estate planning professional since estate and gift tax laws are very complex and ever-changing. This increase in the basic exemption amount by roughly $5 million per individual allows higher net worth clients the ability to make additional lifetime gifts in order to reduce the size of their estate. Since the gift and estate tax changes under the TCJA sunset after 2025, one of the key questions is whether or not these large lifetime gifts made under this temporary increase would be subject to what's called a clawback into the estate of the party making the gift once this law sunsets. However, the Treasury Department has addressed this issue, and on November of 2018, the Treasury Department issued proposed regulations stating that the sunset of the federal estate and gift tax provisions would not be subject to clawback provision applied on these larger gifts made during this temporary increase. This provides higher net worth families with an option to manage future federal estate taxes by using the additional increase to make large lifetime gifts now before the law sunsets or a future Congress changes the rules before then. In addition, since the estate and gift tax was not repealed during the passing of the TCJA, many high net worth clients may feel that the estate tax repeal is unlikely at this point. Additionally, efforts to lessen or eliminate valuation discounts by way of what are called Section 2704 discounts were withdrawn by the Treasury Department in late 2017, but they could return at some point in the future. Now, planning for the 10-year rule. There's a couple ways that one can plan for the IRA 10-year rules that have been in place as a result of the Secure Act that passed. One is to designate beneficiaries who may be in lower tax brackets and leave other assets to higher income heirs. When you pass the retirement account to more beneficiaries, this will also spread the inherited balance among more taxpayers. This may help control bracket creep for heirs by allocating taxable income across more tax returns. While two beneficiaries could spread the inherited retirement income across a maximum of 20 separate tax returns, which is 2 heirs at 10 years, leaving the account to say 5 beneficiaries could spread that income across 50 tax returns. If you leave account balances to spouses, that is another option, which spouses are not subject to the 10-year rule. Heirs also will want to plan distributions from these inherited retirement accounts in conjunction with their income and other tax variables. For example, some heirs may benefit from prorating withdrawals from the retirement account over 10 years. Other heirs may want to withdraw more during years when income is lower or deductions are higher. Another option is what's called a charitable remainder trust, which may be an option to benefit from a tax deduction and provide income to non-spouse heirs over a longer time period than 10 years. The account owner designates the CRT as the beneficiary. Upon death, the IRA is transferred tax-free to the charitable trust, which can then provide income for heirs based on lifetime payments or a 20-year term, with the remainder interest retained by the charity. Some retirement account owners may see a benefit from funding life insurance premiums with account distributions while living, as a means to create a legacy for that next generation. The life insurance is properly structured within an irrevocable life insurance trust, can pass assets to heirs free of income and estate taxes at death. And finally, while many estates will fall below the exemption level, this does not mean that only individuals and families with significant wealth need to be focused on estate planning. The reality is, proper estate planning extends well beyond minimizing or preparing for federal estate taxes. It's critical to have the right documents in place to address the risk of these unforeseen circumstances, such as incapacitation, as well as plan for the orderly and efficient transition of property at death. Now, finally, we will discuss the small business owner deductions. Most businesses in the United States are not large corporations, but are rather structured as what's called pass-through entities, such as S-corps, LLCs, partnerships, and sole proprietorships. While the marginal tax rates for individuals and couples apply, many of these businesses will also benefit from a new 20% deduction of their business income. The new law established a 20% deduction of what's called qualified business income from these certain pass-through businesses. Specific service industries such as healthcare, legal, and professional services may be limited to claiming this deduction depending on their income. Late change in the legislation removed engineering and architecture professions from being considered, quote, the specified service businesses. With respect to the QBI deduction, the law also established this 20% deduction from the pass-through businesses. The specific service industries, which were the law, legal, and professional services, but not engineering and architecture, the QBI is phased out at certain income limits, which is approximately $215,000 for individuals and $430,000 for couples. However, joint filers with income below $329,000 and other filers below income of $164,000 can now claim the deduction fully on income from service industries. This provision, like some of the others, is set to expire on December 31st, 2015. Now, this chart is a flow chart showing how that deduction applies depending on the characteristics of the business. In conclusion, most taxpayers are currently benefiting from the relative favorable tax policies that have been enacted based on the fact that some of these provisions are going to sunset in 2025. Careful consideration should be made to hedge the risks of these taxes when the increase finally does occur, and we recommend that you work with professionals to assess your income and estate planning strategies. And now we'll open the floor to any questions. All right, there being no questions, we thank you very much for your time and hope you have a wonderful day.